Welcome to our channel. Car buying is a huge purchase. Wrong financing can cost thousands. Today, I'll reveal the best ways to finance a car in 2025, plus insider secrets dealerships hide. Please subscribe, like, and share. Let's dig in. Understanding financing saves serious money. We'll cover traditional to unconventional methods. By the end, you'll know the right option and how to get the best deal. Here's a real example. Sarah financed a $30,000 SUV at 7% through her dealer, paying over $8,000 in interest. Her neighbor Mike got the same car at 4.5% from his credit union, saving over $3,000. Same car, same credit, different choice, a $3,000 difference. Your financing choice is critical. Here's why it matters. The average car payment is over $500 per month, and many overpay by not exploring options. A smart financing deal can save you thousands, enough for a vacation or even a house down payment. Consider a $25,000 car loan over 5 years. The difference between a 6% and 4% rate is over $1,400. That's real money for your retirement, kids' education, or emergency fund. People often fall for a car, then accept dealer financing without shopping around. That's like paying any price at a restaurant without seeing the menu. It's financial suicide. I'll ensure you never make that mistake. Dealer financing represents a very traditional route to securing an auto loan. In this scenario, the dealer essentially acts as a middleman, taking your application and shopping it around to a network of various lenders. They then present you with the offers they receive. Its biggest advantage is undeniable convenience. It's a one-stop shop where you can handle both the car purchase and the financing all in one place. This can save you time and effort. Dealers also frequently offer attractive promotional rates, such as 0% financing or significant cashback incentives, particularly on new car models. These deals can seem very appealing at first glance, but it's crucial to proceed with caution. I recall a situation with my client Tom, who was initially thrilled to be offered 0% financing on a brand new Accord. The catch, however, was that he had to forfeit a substantial $3,000 cash rebate to get that 0% rate. After carefully comparing his options, financing elsewhere at a rate of 3.9% and keeping the rebate actually saved him a significant amount of money over the entire life of the loan. There are some serious potential downsides you need to be aware of. Dealers often have the ability to mark up the interest rates they offer you. For example, a loan that costs the dealer 4% could easily become a 6% loan for you, the customer. This seemingly small difference can add up to costing you thousands of extra dollars over the repayment period. Dealers are also notorious for aggressively pushing unneeded extended warranties, gap insurance, and a variety of other add-on products that may not be in your best interest. I had another client, Jennifer, who was quoted a rate of 7.5% for a used BMW she was interested in purchasing. I strongly advised her to check with her local credit union, and thankfully she listened. They were able to offer her a significantly lower rate of 5.2%. On her $28,000 loan, that difference in interest rates saved her over $2,000 in interest payments over the life of the loan. Therefore, if you're considering dealer financing, it's always a smart move to get pre-approved for an auto loan elsewhere first. This gives you valuable leverage to negotiate a more competitive deal with the dealer. The second, often smartest option is credit union financing. Nonprofit and member-owned, they offer better rates and terms than traditional banks. Auto loan rates are typically 1 to 2 percentage points lower. Membership is required but often simple. Some are open geographically. Others require employer or organizational affiliation. Maria, a teacher, saved over $800 on her $22,000 Camry loan. Her credit union offered 3.75% versus her bank's 5.25%. They're also more flexible. With imperfect credit, they're more likely to work with you. They offer longer terms for lower monthly payments, often with no prepayment penalties. David, with a 620 credit score, was rejected by banks. His credit union approved him for a used car loan at 8.5%, significantly better than subprime lenders' 14%. The main drawback, financing is arranged before car shopping and some paperwork is separate. But the potential savings make it well worth the extra step. Bank financing is a strong option, especially if you have an existing relationship. Many banks offer competitive auto loan rates, and loyal customers may qualify for discounts. Online banks often provide the most competitive rates due to lower overhead, passing savings to customers. The application process is quick, often with pre-approval in minutes. Take Marcus, a longtime Chase customer. When financing his $35,000 truck, Chase offered him a relationship discount, a quarter percentage point off their standard rate. This seemingly small discount saved him over $400. Traditional banks offer in-person service, though rates might be slightly higher. They also provide relationship discounts for existing account holders. Online lenders like Lightstream often beat traditional bank rates. Lisa got pre-approved through Lightstream at 4.1% for her Lexus, significantly lower than her local bank's 5.7%. Approval was same day. Let's explore some unconventional yet surprisingly smart car financing options that you might not have considered before. First up is a home equity line of credit, often referred to as a HELOC. This can be a powerful tool in your financial arsenal. If you have built up equity in your home, you have the potential to borrow against it, turning your home's value into accessible funds. One of the most compelling advantages of HELOCs is that they often offer significantly lower interest rates compared to traditional auto loans, sometimes as much as 2 to 4% lower, which can translate to substantial savings over the life of the loan. Plus, in many cases, the interest you pay on a HELOC can be tax deductible, providing an additional financial benefit. Be sure to consult with a tax professional to confirm your eligibility. Take Robert, for example, who needed a $40,000 truck for his business. He discovered that his HELOC rate was a very attractive 3.25%, a stark contrast to the 6.5% he was quoted for a standard auto loan. By opting for the HELOC, he saved over $2,000 in interest payments and was also able to deduct the interest as a business expense, further sweetening the deal. However, it's crucial to understand the risk involved. Your home serves as collateral for the HELOC. This means that missed payments could potentially lead to foreclosure and losing your house. Therefore, this option is generally best suited for individuals with stable and reliable incomes who are confident in their ability to consistently meet the repayment obligations. Another avenue to explore is a personal loan. While personal loans often come with higher interest rates compared to secured auto loans, they can still make sense in certain specific scenarios and offer unique advantages. One key benefit is that personal loans typically don't require you to use the car itself as collateral. This means you own the vehicle outright from the moment you purchase it. This can be particularly ideal for purchasing older vehicles that might not qualify for traditional auto financing due to their age or condition. Personal loans also often offer faster approval processes and more flexible repayment terms. Take Angela, for instance. She wanted to buy a reliable but older 15-year-old Honda Civic. Because of its age, most traditional lenders wouldn't even consider financing it. However, she was able to secure a personal loan at a rate of 7.9%, which was quite competitive considering the car's age, and she owned the car free and clear from day one. For strong credit, cards can be viable short-term financing. Some offer 0% intro APR periods, 12-21 months. Pay off the car within this for a free loan. But discipline is crucial. Fail to pay the balance, and rates are typically much higher than auto loans. Take Kevin. He bought a $12,000 used car with an 18-month 0% intro rate, paying it off in 17 months. He saved over $1,000 in interest, but only by sticking to his plan. Cash remains the ultimate financing option. It eliminates interest, gives immediate ownership, and often provides negotiating leverage for a better price. However, paying cash isn't always the smartest move. If you can get a very low interest rate, finance and invest your cash elsewhere. If investments earn more than your interest, financing is the better choice. Consider Patricia, $30,000 cash for a car. She financed at 2.9% while investments averaged 7%. By financing and keeping her money invested, she came out ahead by over 4% annually. Real wealth building. Leasing is essentially renting a car. It offers lower monthly payments than buying, and you always drive a newer car with warranty coverage. It's ideal if you prefer newer cars, drive moderate miles, and maintain vehicles well. For business owners, lease payments can be a deductible expense, offering tax advantages. However, you never build equity. Watch out for excess wear and tear charges, mileage restrictions, and continuous payments if you always want a new car. The biggest mistake is treating leasing like a car payment, not a financial decision. Always understand mileage limits, wear and tear policies, and end-of-lease costs. Failing to read the fine print can lead to thousands in unexpected bills. Know your credit score shopping. It's the biggest factor in your rate, so check it early and fix errors. Shop around, get quotes from multiple lenders, don't accept the first offer. Even 1% saves thousands over the loan's life. My strategy? Get quotes from at least 4 sources: bank, credit union, online lender, dealer. Compare rates, total cost, fees, and terms. Focus on total loan cost, not just monthly payment. Longer terms mean lower payments but more interest. Aim for the shortest term you can afford. The math. On a $25,000 loan at 5%, a 4-year loan costs $2,625 in interest. A 6-year loan costs $3,967. That lower payment costs you an extra $1,342. Negotiate the car's purchase price from financing. Don't let dealers combine discussions. It obscures your true deal. A strategic down payment can significantly impact your car buying experience. Consider putting down a larger sum up front. This reduces the amount you need to finance, leading to substantial savings on interest over the life of the loan. Plus, a bigger down payment can potentially help you secure a better interest rate from the lender. However, while a larger down payment is beneficial, it's crucial not to deplete your emergency fund in the process. As a general guideline, aim for a 20% down payment on new cars and 10 to 15% on used vehicles. This helps you avoid being upside down on your loan, meaning you owe more than the car is worth, especially as it depreciates. Be wary of dealer add-ons such as extended warranties, paint protection, or gap insurance. These are often presented as essential but are frequently overpriced and may not offer the value they claim. You can usually buy these products elsewhere for significantly less if you determine they are truly needed after doing your own research. For example, a client was quoted $1,200 for gap insurance at the dealer, but by shopping around, they found the exact same coverage for just $240 elsewhere, resulting in substantial savings. If your credit isn't perfect, don't despair. Credit unions and specialized online lenders often offer auto loan options tailored to individuals with less than ideal credit scores. To improve your chances of securing better rates, consider the possibility of having a cosigner with good credit or focusing on improving your own credit score before making the purchase. Timing can significantly impact your financing options. Keep an eye out for promotional deals that often occur at the end of model years, months, or financial quarters. During these periods, manufacturers and dealerships frequently offer incentives like 0% APR or cashback offers to move inventory. Always read all paperwork carefully before signing anything. Make sure you fully understand the interest rate, the loan term, the amount of your monthly payment, and any associated fees. Don't hesitate to ask questions about anything you don't fully understand. It's better to clarify up front than to face unexpected surprises later. Remember, even after you've secured a loan, you can always explore the option to refinance your auto loan later on. If interest rates improve or your credit score rises, refinancing can potentially save you a significant amount of money over the remaining loan term. Your best financing option is personal, but credit unions often offer the best rates and service. Don't overlook other options that fit your unique needs. The goal is the best deal, not just approval. Research, take your time, and never feel pressured. Car financing doesn't have to be complicated. Use these strategies to secure a great deal on your next car. Here's your action plan. 1. Check your credit score. 1. Join a credit union. 1. Get pre-approved from at least 3 sources. 1. Negotiate car price separately. 1. Read every document before signing. Smart financing saves thousands. Keep that money in your pocket, not the dealers or banks. Make the smart choice. Subscribe, like, and share to help others save time and money. Watch our next video.